Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Tchir of Academy saying there is still risk ahead, writing, quote, "I'm looking to take out the August lows. I really think there has been a major disconnect between people believing that we had capitulation versus having seen any actual capitulation." Pete joins us now for more. Pete, good morning to you.
Good morning.
Taking out the August lows seems absolutely terrible. And then I look at the August lows on August 5th of about 5,100, about 8% south of where we are right now. It doesn't sound so bad. What was it about August 5th that you wouldn't describe as capitulation?
You know, I think a lot of people looked at the VIX hit 65 at 8:30 in the morning. It was a calculation, right? No one actually traded VIX futures much above 40. So I think people really took comfort. Oh, we had this VIX hit 65, everything calmed down. There was never really panic in the futures market. There was never panic during the actual trading hours of the U.S. market. So I think people started reloading the boat and saying, oh, we're good. We've had this washout trade, we've had the capitulation. I don't think we've got that. And as we start nearing this, the NASDAQ 100 is already back close to those August lows. I think we push through this. We've got another maybe 10% downside. I don't think we get back to the March lows, but I think there is room for further downside.
You suggest there was no panic. I would suggest in Japan there was panic. The biggest one-day move since 87. At one point that morning, dollar yen had dropped down to about 140, 170. That was a 3% move. Are we suggesting for the global picture that was the tremor and not the earthquake?
Correct. I think really it's the U.S. market that matters. And the U.S., we watched what happened in Tokyo overnight. We got that little bit of panic in the morning. Futures were down, but it actually opened fairly stable, started turning around by the end of the day. Then the next day we rallied. It went probably further than I think we should have, but that was kind of obvious. But everyone just feels like, oh, we've washed out all the bad longs. This is all good. We can really rebuild from there. And I don't think we had that sort of a washout trade, and I don't think we can rally much further until we get that washout trade.
What's the catalyst for that 10% downside and for that washout of those longs?
You know, I think as usual, part of it's just going to be positioning. People have got them positions very long. People have been reloading in all sorts of vol selling strategies. You know, the one thing I keep watching is NVDL, which is a 2 times levered NVIDIA ETF. I don't understand why we have leveraged single stock ETFs. They make no sense to me. There's a huge drag on performance just the way they're set up, and yet that keeps getting inflows. And to me, until we see something kind of shake the faith of that trading crowd, that's when I think we kind of see the bottom, and it's not getting the inflows now, and we're having a lot more questions about AI. I think that's going to be the catalyst. Like, is the promise got ahead of itself?
So this is going to be led by big tech, from what you're saying, that you think that this is going to be an ongoing kind of deterioration from the beta trade that we saw earlier. I'm just wondering what the economic backdrop is for this, because some people might say overly bullish, overly complacent. You're saying the sky's falling and a recession is imminent. Is that the case?
No, I think I think the one thing we've now done is actually priced out the soft landing as guaranteed, right? So now I think there's at least some possibility of a harder landing. So I've been looking for a bumpy landing. I think you're going to see bits and pieces of data showing, positives, negatives. It's going to be by industry. It's going to be, regional. This to me is really, again, just about valuations. When I started on Wall Street, first trading day, they talked about options. They said, if you buy an option, it gives you the right to sell high, right to buy low. You get to trade the gamma. And like, what's everyone want to do? And like, we all raise our hand, buy options. And like, no, it depends on the price, right? Depending on the price, you want to sell those options because you're getting paid more than that. So I think that's where we've hit on a lot of these stocks. We've moved beyond what's rational in terms of what they can generate, and it's disappointing. And sadly, we talk about markets and these broad markets, but 50% of the indices are really just a handful of companies. So it really does matter what these 10 to 20 companies do.
Where's this concern about the election and politics play into your bumpy landing?
I'm kind of really confused. What are we even going to see tonight? Like, at this point, I haven't bothered spending any time really trying to figure out what either party's policies are going to be, because I don't think we've had any sort of definition. Where I've been working is what I think is going to stay the same, and that is really going to be, no matter who wins, this friction with China, this tech battle is going to continue. We are going to see more and more protectionism around AI, the semiconductor business. I think it goes back to one thing you were talking about earlier, Europe. Europe is not going going to be good for AI. Europe's not going to be a good investment vehicle because it's all about constricting and constraint and rules and regulations. So I don't think that's going to be a hotbed of this. So I think ultimately the U.S. is going to do well, but we are going to see friction with China on that. And I think whoever wins is going to have to rebuild the U.S.'s reputation globally. Where do we stand with our enemies? And more importantly, where do we stand with our allies? Do we have 10, 20-year, 30-year commitments, or do we live election cycle to election cycle? So I don't think anything that is going to come out tonight on that, but those are things I'm going to start looking for as we near the election.
A lot of people's base cases is gridlock in Washington, but some of the issues that Trump talks about, like tariffs, we spent a lot of time in this program talking about that, he could do unilaterally on day one. So have a massive impact on what's going on in China. Do you think China is basically waiting to find out what happens with the election because their economy is suffering before they really have some policy moves?
I think everyone's on hold a little bit. They want to see how this plays out. I think everyone has a decent understanding of what Trump does or doesn't do. He says a lot, and then he tends to back down. We're not sure what Kamala is going to do. I think people want to see what she's going to be like, and will she be easier to negotiate with, right? Will people prefer to negotiate with her, or will they prefer to stick to Trump? So right now I'm kind of discounting everything both sides say, and that is probably, I think, one thing is we're all kind of assuming split tickets. If there's something that comes out that one side is really going to win completely, then I think that changes the narrative for Wall Street. Then we have to pay a lot closer attention to the risks.
Let's just park the politics just for a moment, just to wrap this up. When I walk away from listening to this conversation, Lisa correctly identified that you see tech and the AI trade as the biggest risk. A failure to demonstrate where this return on investment is going to come from. Was the Apple unveiling the beginning of that yesterday? Do you think it was?
It did not seem to give that excitement, but you've seen some of the earnings come out. Oracle had great earnings last night. They're up, but yet the NASDAQ 100's down a little. Futures are down a little bit this morning. So I think it's taking more and more to get that story. The one positive thing I'll say that I keep an eye on is Walmart did come out and say that AI really helped them with their quarter and in their planning. So I need to see more of that to believe it. And right now, what I'm seeing is a lot more people I think who've been struggling through using these LLMs or generative AI. They all keep coming back like, is it there yet? And since the cost rose so quickly with the cost of chips, the cost of getting data centers, electricity, that I think the risk reward or the cost benefit's not there right now, and I think that's what we'll see some slowing down on.
Peter Tchir looking to take out the August lows. Peter Tchir of Academy Securities. Peter, thank you. Roth Smith of Slingshot Strategies writing, Harris heads into Tuesday's debate still searching for a durable advantage in the states that will decide the election. But with important openings, she can press. Evan joins us now for more. Evan, good morning, sir.
Good morning.
Let's talk about the very specific, highly specific pre-debate polling that you've been conducting. Can you just walk us through it to begin?
Well, this election is increasingly becoming focused on the handful of voters, really only about 500,000 voters, who are going to decide the outcome, right? So these are swing voters, largely independents, in 6 states, right? The 6 swing states in the Rust Belt and the Sun Belt that we all know about. And this debate is largely about them. What do they want to hear? What do they need to hear? And particularly, what does Kamala Harris need to tell them to get them over the edge and make this more than just a knife's edge election, where she's clawed back out of the hole that Joe Biden was in and reached basically parity with Donald Trump, where this election could go either way, as just about any analyst or pollster would tell you. And really what these swing voters in these swing states want to hear, at least in our polling that we just released this week, is they want to hear her continue to gain ground on the economy, to press her advantage on prices, right? Donald Trump still has a very narrow advantage, a 2-point advantage overall in these swing states on inflation and jobs. But with independents in these swing states, Harris has a 4-point advantage. These are very close to margin of error, but it means these critical voters are looking to hear on the economy and hear on prices specifically, and she has to mitigate concerns on immigration, where she's still down in these swing states to Donald Trump.
Evan, when you look at the New York Times Siena poll over the weekend, more than 60% of likely voters said the next president should represent a major change from Biden. Do you see that in this polling group that you're going after in the swing states?
So it's interesting. We polled this with independent voters in swing states. Who represents change? Who represents the right kind of change? And voters in these swing states, independent voters, by 10 points say that Kamala Harris is a breath of fresh air. And she is. It's undeniable. She's a breath of fresh air in this race. But by only about 7 points do voters say that she's the right kind of change. She's still more or less tied with Donald Trump on being a change candidate. And that's because she hasn't yet broken in a meaningful way, rhetorical or policy-wise, with the administration. She isn't a change candidate beyond the literal change of who the candidate is. And now, that slight advantage on the right kind of change with independent swing state voters is very good, but she needs to do more. She can do more.
Does she need to completely break with Biden in your polling to win over those voters?
I don't know that it's a complete break with Biden. She doesn't need to. He's the sitting president. He's her sitting president, her running mate in 2020. You know, there is some merit to the idea that she could draw greater distance, particularly on immigration. There's very little downside to drawing distance. But on policy, most of the Biden policy agenda, when it's not tied to Joe Biden, is very popular when you poll it. So how do you break with the president? You can't break with him on policy. You have to break with him in more subtle rhetorical ways. And we'll see what she does. We'll see how she manages that. And you also want to continue to be able to take credit for things that the administration does that is very popular, like Medicare negotiation of prescription drug prices, which is enormously popular, including in these swing states with these swing voters.
How engaged are some of the independents and prospective voters, those 500,000 people that are going to determine the election? I mean, how much are they watching every iteration, looking for policy, trying to understand the two candidates?
Well, that's really what's critical tonight, because those voters are looking to learn. A lot of people who follow politics closely, journalists, practitioners, the kind of people who get up at 6 in the morning to watch the news and get a little edge on everyone else, we know a lot about what's going to come out of their mouths. These swing voters who haven't made up their mind, they're watching to learn. They're not necessarily watching for the repartee, the zingers, and that's why I discount the mics being on or off or anything like that. The voters who will determine this election really, really care about what these candidates are saying. They're looking for substance. They're looking to be educated. They have open questions, largely about Kamala Harris, very, very much less so about Donald Trump, and they want answers to those questions, particularly on the economy, particularly on her immigration policy and how she's going to be different than the status quo. And an important mission for Harris is also to raise the salience of abortion and reproductive rights in this election.
That's what I was going to say. How do you sort of pair those two ideas, the social versus the economic, especially at a time where, frankly, there isn't that much daylight when it comes to certain policies, particularly with China versus the U.S. and other international issues between Trump and Harris?
Well, on foreign policy, you know, Harris is very fortunate in that the part of the Biden administration agenda and policy set that she is tied the least to is foreign policy. So she can kind of do it and say whatever she wants and feels she needs to do and is politically advantageous. It's also true that the vice president has had very little to do with American foreign policy over the last 4 years. You know, short of Dick Cheney, it's hard to find a vice president who has.
Evan, can we pick up on who she is? To independents, at least. Is this the person that ran back in 2019? 2020? Is she progressive in moderate clothing here in 2024? How do they see her?
She's not. I mean, when she ran in 2019, it was in a Democratic primary where she didn't even make it to Iowa. She never saw the voters. In 2020, she's a vice president on a presidential ticket. And also, it should be noted in a year where campaigning was different than any other presidential election in our lifetime, right? She wasn't barnstorming the swing states. Media consumption was very different during COVID. And so she is very much doing her first introduction to voters. We're now a couple months into that introduction, so things are starting to firm up. But this is, you know, we did this test on what policies, what campaign promises that Harris has made do you believe she will try and succeed on, try and fail, and not even try? Right? So these are all policies that that the campaign has promised to pursue. And on some things, like the child tax credit, voters really believe she will try and get it done. On other things like deficit reduction, she's underwater by a couple points, right?
She's not the only one.
She's not the only one. She's not the only one. I mean, where's the candidate who hasn't promised some form of deficit reduction? But so there's still elements of her record, and the border, by the way, her promises to following up, trying to get the bipartisan border deal done. Voters more or less buy that from her. Surging resources to the border, which is a popular idea that her campaign has promised to do, more border agents. Voters aren't quite sure that she means that promise. So there's reassuring to do. It's less about new promises. It's more about affirming that that the things she has promised to voters are real and something she will try.
As something you imagine the former president will be pushing on pretty hard a little bit later on this evening.
I think they're all just going to be watching the $58 billion auction at 1 p.m.
Is that right?
Yeah, because they're all very focused.
Fixated on deficit reduction.
Make deficits great again.
Evan, thank you, sir. It's good to see you. Let's do it again soon. Evan Roth-Smith there. Limits of this bond market rally. We've had a big move last week of almost 30 basis points lower on a 2-year yield. The 10-year yield dropped by close to 20 basis points in a single week. We've seen a big move lower through the summer as well. Are we reaching the limits of this bond market rally?
I think so. I think we maintain models and we think it's overshot on the downside. Pretty much if you have a Fed funds rate of 3.5%, which I think is close to the natural neutral rate on the nominal side, and typically post-cutting cycles, if you have the yield curve pricing in another 50 basis points on the 10-year, 4%, anything lower than that seems to be like overdone.
You mentioned 350. Do you think we're actually quite well priced already for 200 basis points worth of easing?
I think on the last couple of years, the market's pricing any kind of move in the market in an extreme way. So we are really well priced on that, I think. And what I think is important on the inflation side, a lot of our work is suggesting that the next few months, inflation, the pace and path of inflation is going to get a little more difficult in terms of the disinflationary trend. So it may just stabilize, so you may not see consistent prints down. What's going to happen beginning of next year? The 2004 beginning had a very high base effect because of high inflation. So beginning of next year, inflation's actually going to be better and trend down more. So I think that's the path I'm working with, and from that perspective, Treasury seem to have overdone.
They might have overdone, but that doesn't mean not to own them in the same kind of way. You have an interesting point about 60-40, that we're going to see kind of a reversion back to that kind of balance in terms of opposite reaction to stocks. How much can you lean into that story given the fact that you have already seen this huge rally? Does it still stand?
It still stands because the most important reason the 60-40 did so terribly in 2023 when this combination was down 17% was because stocks and bonds correlation got positive. And history suggests that whenever inflation is above 2.5%, stocks and bonds, this is for the last 75 years, stocks and bonds correlation gets positive, which is taking away the diversification benefits of bonds. Now with inflation coming down below that level, that correlation will reassert its negative relationship. And I think in an overall asset allocation portfolio that's a more structural long-term portfolio that gives you the benefit of having that hedge with the duration in case the outcome on the economy is worse than the consensus soft landing.
How hard of a sell is that right now, given how scarred people were over the past few years and some of the losses that you saw in bond portfolios and some of the questions people have around the deficit, around some of these other sort of structurally higher inflation types of regimes that some people are talking about?
Yeah, I think the question on the 60-40 was a bigger question in 2024 because 2023 was such a worst outcome for that combination. I think at this point there is more recognition that that may be a good allocation, but what people are doing and what asset owners are looking to do is, think about what in that 60-40, right? Whether if it's 40 in U.S. Treasuries, let's look at emerging market debt. If the dollar is weak and interest rates are coming down, then the local bonds in the emerging market world will do well. So what within that 40 is an interesting question. And what within that 60? Interest rate differentials, growth differentials that have worked in favor of the U.S. all along now seem to be peaking in favor of the non-U.S. world because the pricing in the U.S. interest rates is much more aggressive than many other markets in terms of rate cuts. So how do we look at the ex-U.S. universe, even in the equity space, is another important consideration within that broader allocation.
So could we go deeper into that idea? What do you like within the 60, within the 40?
Yeah, so, I'll start with the U.S. clearly we've liked the equal weighted index because we think concentration is extreme, peak multiples, peak earnings in some of these technology stocks. Within US, we do like pockets of industrials, financials with the yield curve steepening. We really like pockets of Europe because there are idiosyncratic reasons, but also structural reasons. The world is industrializing. A lot of the industrial companies are in Europe, trading at very cheap multiples. We like pockets of Japan that are leveraged to an appreciating yen because we think that the path for the yen is up. We do like several emerging markets like India, Southeast Asia, that are also more consistent growth stories.
You're not mentioning China.
Yes, I've been a bear on China for a while. I think China has three problems. It has the excessive debt, it has a demographic headwind, and it has a deglobalization headwind. I mean, look at what it's doing. Like, it wanted to raise consumption, but it's ending up following the industrial policy again, dumping goods in the world because that's the only engine for growth in terms of the export side. The domestic economy is laden with unproductive debt, which is slushing around the system without a cleanup act. So that continues to be something that may have some tactical runs, but not a structural story for asset allocation.
Can you reconcile that with your more constructive view on Europe? If you don't like China, how can we like Europe? Isn't that just a play on China?
So, Europe, of course, the consumer story in Europe and the brands, the luxury brands, that has a problem. And some of it is getting priced in pretty decently with respect to current valuations. But I think in some of the global themes today, which is whether it's defense capex, it's industrial automation capex, it's resilience capex, substitution capex, some of the European stories are linked to that. And, pockets of energy, materials, UK has a large part of metals and materials kind of companies. So I think scattered around, it's an active time for active management. You really need to kind of pull the thematic leaders from these different countries.
We've all heard these arguments a million times, of course, and the question I always sort of go back to is valuation gap or valuation trap. What are they doing right now that deserves the premium you think these companies demand? How are we going to attract that kind of capital back to Europe, back to the UK, given how they've squandered it for most of the last few decades?
So in certain pockets of Europe, the earnings inflection is happening. So it's not a valuation trap when there's a catalyst to unlock that value, right? So that's what we're focusing on. And I think when you talk about valuation, you really have to think about equity valuations and currency valuations. So the dollar now is really extended. And as I said, the rate differentials and the growth differentials that have favored the dollar all along in the last few years, that's now going to favor the ex-US universe. And work suggests that nearly a third of returns on average come from currencies. So taking that nuanced currency view across international markets is another big part of.
Can we explore that just one step further? If that big dollar long that's been accumulating over the last few years, which essentially that's what it is, it's a massive dollar long at the expense of the rest of the world into dollar-denominated assets. If that begins to unwind, there's a whole host of people out there, deep thinkers, who think that maybe you engineer moves of like 10% in the Chinese currency, big moves, say, in the euro as well. Do you think about it the same way? And what kind of destruction would that cause for the US assets that money was originally in?
Yeah, so dollar is not an emerging market currency, right? It's not that, it's not a currency that's so volatile. I think if you plot a long-term dollar price, it trades between that 10 to 15% band. So I think there will be counter-trend rallies. We're probably, at a point on the tactical side where the dollar, a little more weakness could get a counter-trend rally on the upside. But I think the home bias in the US with just US assets, U.S. domiciled assets, that probably that shift, if that were to come, should lead to some assets moving away from the dollar. Not something that dislocates and calls for a demise of the dollar, because it still is the reserve currency. It still has the exorbitant privilege. But I do think that dollar weaknesses have happened, like in the 2000 decade when international markets did better. I think we're getting to that point.
We used to come over here and basically chop everything in half. Do you remember that? 50% off? You won't remember that. As a Brit coming to America, used to come here and just do 50% off. It was 2 for 1. Great times. Great times. Obviously, I live here now.
It was the other way around, by the way.
Yes, I was speaking to our producer Jamie about that, and Jamie was talking about the other way around, how expensive eating was in London back in the day.
It was absolutely absurd. And now that's why the US can't get enough of everything European.
Exactly.
Because you're on sale.
Yeah, in a big way. I live here. I'm one of you. Jitania Kandhari of Morgan Stanley. It's good to see you. Thank you.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.